Hello and welcome back, guys. In this video we are taking a look at the GEO Group. It's the only company that Michael Burry owns right now in his stock portfolio. I did make a video about it yesterday. Michael Burry pretty much sold out of every single stock that he was holding, and he only bought this one, GEO Group. You can kind of see what happened here. If you take a look at that aroma, you will see that this is Michael Burry, Scion Asset Management. He sold everything here. And the only thing he held is actually GEO, is the only thing that he actually bought right now, which is a prison company, and you may be wondering why he did that. Now the why can be a little bit tough to determine. There are some discussions about politics and pretty much this being the reason why Michael Burry bought this one. But what I do want to examine here is the financials of the companies, what we typically do. And you can kind of see here in our tool that we have a full, metrics page, and of course our evaluation tool can really help us with analyze this company. Before we proceed any further, please remember to leave a like, that helps a ton, and subscribe if you're not a subscriber already. And of course, you can always get access to this tool by becoming a patron. All the links are in the description box below this video. Okay, so what is going on here with this company? If you take a look at the 3-year chart, it's a company that's going down pretty much. And the 1-year chart is the only one that kind of shows you a little bit of a sort of like reversal here, along with the rest of the market when everything went down and then went up again. Overall, it's still down about 22% since its 1-year high. But remember, yesterday on the news that Michael Burry bought the company, it was up about 11%, and right now pre-market is up 5%. We're looking at an about $8 price when the stock market opens today, it looks like. Okay, so the P ratio of the company is sitting at 14.6 here. It actually used to be a little bit better than what it is right now, but it's still not too expensive. Remember, this is, however, a company that is not really growing, and it's sitting at similar levels, if not worse levels, than what it used to be 5 years ago. So even this P ratio here could be expensive for a company of this sort. However, the price to free cash flow is not that expensive. It's actually pretty cheap at 4.4. So this is a little bit better here. In terms of outstanding shares, the company hasn't been printing any, really, just a small portion, less than 1%. Not really considering. I'm not really considering the big thing here. It wouldn't really affect me too much. It's going to affect my decision. But what would affect my decision is the debt of the company, and this company seems to be having quite some debt here. Take a look at the total liabilities ratio compared to the free cash flow that the company generated last year, and also the debt to equity ratio that the company has right now. Now, what do these mean? The total liabilities to free cash flow is actually a metric that tries to relate the free cash flow that the company generated last year to the total liabilities that the company has right now. And the total liabilities include like debt and things that the company needs to be paying suppliers, things of that sort, pretty much liabilities that they will be having in the next 12 months. In the next, not even 12 months, it's in the next few years potentially. This is the total liabilities, not just the current. So what does that mean exactly? If we take a look at our financial statements, you will see here, if we go to our balance sheet, you will see that the company has about 3.5 billion in terms of total liabilities. And last year, again, you can go to the cash flow statement, and they did 200 million in free cash flow. And as you can understand, this is an about 16. If you divide these two values, this is an about 16 multiple of its free cash flow that the company owes in total liabilities. That's quite significant. It means that it's difficult for the company to pay back all their total liabilities. They will more than likely have to burn some cash at some point if keep being at the same similar metrics here. And the other thing that is very, very crucial to see, again, we can kind of go here to our balance sheet, and you will see in a little section here that the total debt of the company is 3 billion. And 3 billion, while the total liabilities is 3.5 billion. So a lot of debt is part of these total liabilities, not so much payables, for instance, to suppliers. And if you compare that to the total equity, the total debt divided by the total equity, it's a factor of 3. So 3 times debt for 1 time total equity. And this is why you are looking at a 3 here, at a 300% pretty much. Whoops. When you take a look at our metrics page, this is what it's telling you here. If you go back, you will see the 3.01, pretty much telling you that the debt to equity ratio is still rather high and has been increasing through the years. Just a little bit of a reduction in the last year, but still overall increasing, and it's not nice to see. Now, the margins of the company are also rather low and going down as well. So, what is to like in this company? There's not much to see here in terms of financials. It almost seems like a deteriorating company. And so I was wondering what causes this kind of potential purchase from Michael Burry. Now, I have heard people talking about politics, reasons that have to do with politics here, which could be the case. But there is also a discussion about the potential short interest of the company. So people are thinking that this could be pretty much a short squeeze play. And if you take a look at the percentage of float that is shorted right now, it's actually sitting at about 16%, and it used to be higher even. So it's not like the company is at all-time short interest highs. It's actually lower than what it used to be. So this also doesn't make too much sense to me. Although Michael Burry, I guess bought it earlier, so I guess the short interest was higher. But still, it's not that tremendously high. It's still pretty high. But I'm not really sure whether he would actually, go for that kind of trade. Okay, so let's go back. I just wanted to mention that because it could always be sort of like a trade pretty much that he would be selling, after it gets to a certain level, potentially, maybe. Okay, so what's next? If we take a little bit of a look here at the financial statements in a little bit more detail, you will kind of see the story. Revenue that is about the same, and net income that is actually going down pretty much 50% since 2017. And we did examine the balance sheet again. Remember, the total liabilities were too high, 3.5 billion compared to the total equity of 1 billion. And also, if you take a look at the cash flow statement, the cash flow that the company generates, for example, the operating cash flow here has also been going down, with a free cash flow pretty much sitting at a little bit of a lower level since 2017. So again, it's not a company that's growing, so it doesn't make a ton of sense for somebody to be acquiring this one for a long-term hold at least. It may be a temporary play though that Michael Burry is actually targeting here. It is a potential thing. It could be happening. So, if we take a look at our stock evaluation tool next, maybe we can actually get some more information in terms of whether we would like to sell or buy this one. Now, the revenue growth has been up and down quite a lot, of course. And what I do want to use here, I remember the company was at a near 0%. So I'm going to go 1, 2, and 3 in terms of the revenue growth. And the net income margin, it's going down a little bit. 2, 3, and 4 is what I'm going to be using. And 80, 90, and 100 is what I'm going to be using here with an annual return of 13%. Yeah, so the company again hasn't been growing that much. There's a little bit of a fluke here in terms of the revenue growth. This is wrong. I'm going to be fixing that, some sort of a data issue here. But overall, you have seen in our previous metrics page here that the company hasn't really been growing their revenue. We kind of saw that in detail. If you take a look at the metrics page, I can open it again. You can kind of see here the full story. Again, the revenue growth of the company has been at about a similar level here, 2.2 to 2.4 maybe billion, and it's not really growing. It's going backwards pretty much. So we are going to assume a little bit of growth here, 1, 2, and 3, and see whether that happens. Maybe not, but let's just go with 1, 2, and 3%. It's been down a little bit, so maybe it will achieve that in the upcoming years or so. So if we do that, we're looking at a red price, which is not a buy for the low and medium ones here for our estimates. It's only our high ones that are a buy, with our current price being at about 8 actually. So this medium is not that far, frankly speaking. And so what if we went 0, 0.5, and let's just say 1 here? What will we be getting then? This is a scenario that is a little bit more likely to play out, and 1% we're kind of still in the range with this net income margin, which 4% could happen. It's about where we are right now, pretty much. That was last year. So yeah, this may not be a horrible buy. I mean, just for holding through some years, and the company maybe gets a little bit better in terms of their revenue growth, or even stays at the same level. You could see the company go at about 10, maybe, or maybe 11, or something of that sort. So it's not like it's a horrible buy. It's not like a buy that is like super overvalued that nobody would enter at any point. It could still be an interesting potential hold here. But with all the all the things that exist right now in the market and all the opportunities, this is not one that I would be buying myself unless I had a very clear reason. And so unless he's looking at a short-term play like a short squeeze, or maybe he has some information about the company, or what is going to happen in terms of politics that may actually help benefit the company. I can't really see much in here. Maybe it's a short-term trade, who knows. But I just can't see too many things for me to be entering this company right now. I did think it was very, very interesting to talk about it though, because a lot of people could be looking at it thinking whether it's a nice purchase or not. So I wanted to make a video and analyze it. And thank you for watching. Please leave a like if you did enjoy this one, and I'll see you in the next video, guys. Bye bye for now. See ya.